Welcome to the deep dive. Today we are on a really critical mission for anyone navigating a career in tech.
A very high stakes one.
Yeah, we're doing a forensic analysis of the monumental battle between Google, that's Alphabet, of course, and Meta platforms.
And this isn't just about stocks or quarterly earnings. This is about what you are actually signing up for. You're choosing a lane.
You're choosing a whole career philosophy, really.
That's it. Do you want the stability and the methodical engineering rigor of Google? Or are you chasing that aggressive, high growth, high volatility world that is Meta?
Right. And to help you figure that out, we have pulled apart everything.
Everything. Detailed financial metrics, insider notes on how their comp is structured, deep dives into the culture, and the latest on this cutthroat AI talent war.
So our goal today is to really unpack the structural differences. We want to go beyond just the big, impressive TC number, the total comp package.
Because a $400,000 TC at Meta is not the same thing as $400,000 at Google. Functionally, it just isn't.
And understanding why it's critical for your long-term goals, both financially and, for your career.
Okay, so let's jump right in. The financial architecture. Cash versus equity upside.
The compensation philosophy.
Exactly. And look, both companies pay top of market. There's no question about that.
Yeah.
But the data really shows Meta aims for a higher overall TC, especially when you get to the senior levels.
And we even see it at the entry level. So for like a new software engineer L3 at Google, E3 at Meta's already trending a bit higher.
Right. What are the numbers there?
You're looking at maybe $220,000 total at Meta versus Google's, say, $190,000. And a big chunk of that difference is actually in the base salary.
Which is interesting. So more guaranteed cash.
Yeah, Meta might offer a base around $153,000. That's cash in your pocket no matter what the stock market is doing.
But the massive difference comes at the senior level.
Oh, yeah.
You're talking L5 at Google or E5 at Meta, the standard senior SWE role. The gap is just substantial.
What's the estimate?
Sources put a Meta E5 at around $467,000 a year.
Wow.
Compared to Google's L5 at about $378,000.
Okay, so that's a nearly $90,000 difference. That's not small change.
Not at all. And that gap isn't your base salary. It is almost entirely from the restricted stock units, the RSUs.
So it all comes down to the stock grant. That's where Meta is playing this really aggressive game.
The annual grant for an E5 at Meta is huge. Over $260,000. Google's L5 grant is more like $161,000.
But you said the dollar amount is only half the story.
It is. The vesting structure is the real killer detail here. This is probably the single most important part of this whole comparison.
Okay, break it down for us.
So Google uses a highly front-loaded vesting schedule for their initial grants.
Meaning you get more money sooner.
Exactly. You get this disproportionate chunk of stock value early. So for example, 38% in your first year, 32% in the second. And then it falls off a cliff.
So a massive influx of cash right at the beginning, a huge financial cushion, but then what?
Then you're vulnerable. See, those annual refresher grants Google gives out, they're almost always defensive.
What do you mean defensive?
They're trying to backfill that huge drop in years 3 and 4 just to keep your TC from totally crashing.
Huh. So you're basically working just to stay even after year 2.
Psychologically, yes. It's a fascinating trick built right into the compensation.
So how does Meta do it differently?
Meta's strategy is, well, it's mathematically designed for rapid wealth acceleration. They use an even vesting schedule.
So 25% year?
25% per year, vesting every quarter. Super stable, super predictable.
And what does that mean for the refreshers?
It means when a top performer at Meta gets their annual refresher grant, it's purely additive. It stacks right on top of that stable stream.
Ah, so it compounds.
It compounds, and that's why top Meta engineers can accumulate wealth so much faster over, say, a 4 or 5 year timeline.
And this leads to that incredible financial nugget in the source material, this idea of embedded optionality.
Yes, this is a bit complex, but it's so important. The sources highlight that a 4-year equal vesting RSU grant like Meta's is mathematically valued up to 26% higher than its face value.
Okay, explain that. How can it be worth more than it's worth?
Okay, simplest way to think about it, imagine the company's stock suddenly spikes in year 3.
Right.
With Meta's even vest, you still have half your grant year 3 and year 4 ready to capture that huge upside. That's the optionality.
Okay.
If the stock goes down, you have the option to leave, so you mitigate your losses.
Yeah.
Because Meta gives you that consistent exposure across all 4 years, you maximize your chance of catching a major price spike. Mathematically, That chance, that option,
Yeah.
is real value.
That is a hidden value. That is just massive. Okay, let's shift from the wallet to the workplace, which is maybe an even bigger contrast.
The culture clash. This
Yeah.
is stability versus speed. I
Absolutely.
mean, Meta's whole identity is built on move fast. And that's not just a poster on the wall. The culture is fast-paced, iterative, intensely metrics-driven.
You have a lot more autonomy from the bottom up.
Huge autonomy.
Yeah.
If you're an engineer with a good idea, you're often just told, go start building it. Fewer bureaucratic hoops to jump through.
Whereas Google is the methodical oil tanker. The culture is structured, it's rigorous, it's quality focused to like an extreme degree.
Oh, yeah. You can't start any non-trivial project at Google without a formal design doc.
The famous design docs.
Sometimes they're 30, 40 pages long.
Mhm.
And that's before you get to the multiple reviews, the approvals, the thorough testing.
Striving for, what, near 100% test coverage before anything sees the light of day?
That procedural difference right there just shows you the chasm between them. At Google, the design doc is gospel. It's the price of admission for building anything. It ensures that world-class rigor.
And at Meta, that would be seen as a total drag on speed and impact.
Completely. One optimizes for perfection, the other for iteration and market velocity.
And this feeds right into work-life balance, doesn't it?
Directly. Google has historically offered a much better work-life balance. It was known for having a more lenient performance management system.
Which, let's be honest, made it easier for some people to coast for a while.
It did. Meta, on the other hand, is high accountability. It's got that clear upper-out pressure.
And that year of efficiency push from leadership really amplified that.
Oh, for sure. Employees feel constantly challenged to deliver visible impact, to show the metrics that justify their role. If you love that constant challenge, Meta's your place.
But if you value stability and predictable hours, Google has the clear edge.
No question. And that speed also just dictates your entire career velocity.
Yeah, talk about internal mobility. Meta is famously fluid.
Right. New engineers join boot camp, and they actually get to choose their team after they join. They shop around for the best fit.
And switching teams every couple years is normal, right? No formal interviews.
Super common, super easy. It gives you this broad, almost entrepreneurial experience across different projects,
Which is the total opposite of Google's model.
which fosters deep, deep expertise. At Google, you're encouraged to stay put longer, to become a true guru in a specific niche.
Like search infrastructure or some specific compiler tech.
Exactly. Transfers can happen, but it's a much more formal process with more approvals.
And that leads right to promotion speed. The data shows that.
It really does. Meta's high-impact culture gives you a much faster path to senior or staff level. You deliver, you get rewarded quickly.
While Google's process is slower, more consensus-driven, a lot less predictable, frankly.
And you see a lot of engineers staying at those mid-levels, L4 and L5, for years longer than they might at Meta.
And Google's also known for down-leveling, right? Hiring experienced people, but at a lower level than they were targeting.
Yep. If you don't fit that L5 or L6 mold perfectly in the interview, they might bring you in at L4. You can create a lot of frustration for people who feel they're ready to move faster.
Okay, let's pivot to maybe the highest stakes battleground of all right now, the AI talent war.
This is where the numbers just get astronomical. It is absolutely cutthroat. And Meta is being almost unprecedentedly aggressive,
They are actively poaching top talent.
offering multi-million-dollar comp packages to lure experts away from Google, from DeepMind, from Apple, all to build their superintelligence team.
And some of the rumors are they defy belief. Get this. There were reports of sign-on bonuses for some top OpenAI targets as high as $100 million
100 million.
just to sign on the dotted line. An entire lifetime of wealth.
It's jaw-dropping, but it just shows you the true value of this talent. This small pool of people is seen as the biggest constraint on future growth.
So if you can recruit the 5 best minds in a subfield,
You win the decade. So
Right.
that 100 million isn't a bonus. It's the cost of buying a foundational piece of your future business.
so how is Google responding to this relentless poaching?
Defensively, and in a way that is, I think, even more surprising than the bonuses.
How so?
We found that Google is actually paying some of its most critical AI engineers, especially from DeepMind, to stay on the payroll while being idle.
You mean paying them to do nothing,
Pretty much.
right?
Because of non-compete agreements. They call it a defensive AI chip strategy.
A defensive AI chip strategy.
Google is basically saying, look, We might not have a project for you right now, but your knowledge is so valuable and so dangerous in a competitor's hands, we will pay you millions to just keep your expertise off the market.
That is the ultimate definition of golden handcuffs.
It treats human talent like a scarce resource that you have to hoard.
Unbelievable. Okay, so let's look at the investor view quickly, because even with all this aggressive spending from Meta, the market has reacted pretty differently.
Very differently. Over the past 12 months, Alphabet, GOAG, has just blown Meta out of the water.
What was the return?
A 93% return for Google compared to Meta's plus 9%, which is still respectable, but
Not even in the same league.
not at all. And valuation models reflect that. One calculation put Meta at 13% overvalued, but Google at 46% overvalued.
But Wall Street still seems to prefer Alphabet.
They do. Analysts consistently cite a friendlier valuation and more conservative estimates for Google. It suggests they see it as a safer long-term bet, even with a higher current valuation. Investors seem to prefer that steadiness.
Okay, finally, let's talk about the actual golden handcuffs, the benefits beyond salary that lock you in.
Starting with retirement, which is kind of table stakes at this point.
Both have the industry gold standard, right?
Yep. 50% match on your 401k contributions up to the IRS limit. That maxes out around $11,750 for 2025. And crucially, at both companies, that employer money vests immediately.
Which is huge. It's yours instantly.
A massive differentiator.
Yeah.
But Meta has some financial acrobatics that give it a serious edge for high earners.
The mega backdoor Roth.
Exactly. For anyone who doesn't know, this lets you put additional after-tax dollars into a tax-sheltered investment way above the normal limit.
Up to that total, $70,000 annual limit?
This is a huge tool for accelerating your personal wealth, tax-free. They even have a rare super catch-up match for older employees.
But Google has the Employee Stock Purchase Plan, the ESPP, which Meta doesn't.
Good point. So if you like buying company stock at a discount, that's an advantage for Google.
But I think the ultimate differentiator here comes down to time off.
It really does. Google is known for amazing parental leave, 18 to 24 weeks paid. And they have that unlimited PTO policy now.
Great for flexibility, but Meta's tool is more of a retention strategy, isn't it?
It is. It's designed explicitly to combat that high-pressure culture. They offer 4 months of paid parental leave, but the unique thing is the mandatory, fully paid 30-day recharge leave.
A sabbatical every 5 years.
A mandatory sabbatical.
Yeah.
That month away, paid and guaranteed, is an incredibly high-value benefit designed to stop people from burning out.
Okay, so let's bring this all together. The core trade-off for you, the listener.
On one hand, you have Meta, higher potential TC through that compounding equity, a faster career track.
But it costs you. Intense pressure, volatility, that up or out culture, you have to perform constantly.
And on the other hand, you have Google, which offers stability, world-class engineering rigor, that incredible brand prestige, and a much better foundation for work-life balance.
So you're trading some of that potential equity rocket ship for predictability and, well, sanity.
Exactly.
So I think the decision comes down to this one fundamental question about your professional identity.
I think so too.
Do you want to be defined as a deep, specialized technologist, someone who builds lasting, perfectly engineered systems and prioritizes long-term stability? That's the Google path. Or are you a rapid, metrics-driven builder who thrives on constant change, on impact, on volatility, where speed is more important than polish? And that is the Meta path.
So the question for you to mull over is this. Which of those identities is going to open the most doors for your specific future goals?
That's what this deep dive should help you answer. We'll catch you next time.